Welcome everybody, Andy Tanner here. You can feel the excitement in my raspy voice. I've had a bit of a cough this season, but it is time to, it's my favorite event, Quick Start Lab 2023 Lab. Here we go. Number one. There, 01. I don't know if I put that on there because the Dukes of Hazzard or something stupid like that. I don't know, Corey. But I am grateful for my dear friend, my mentor, my teacher, Corey Halliday, for being with us. How are you, buddy?
I'm doing great. I'm so excited to be here. Like you, I just look forward to the Quick Start Labs. They're so much fun and just a great learning environment for all of us. So excited to
So
be here.
I'm going to pop open my little, I have a little, let me switch to my cursor here, pop open my questions. And we had a record number of registrants this year. This will be the largest group that we've ever had doing a Quick Start Lab. And what is this, the 8th year, Corey? 8 years we've done this? 7?
Yeah, I think it is. I think it's probably 8 years now. Hard to
Incredible.
believe.
I've already got people, look at this. We have V Chang. V Chang, man, I'm familiar. God, I've seen V for a while, man. V's
Well,
here. We got Steve. We got Mexico representing.
people know how to do it. They're already putting in where they're from. We got Mexico, Costa Rica,
I've already got my spinning rainbow. I'm warning you guys, we have a lot of people on the system. So, uh,
Orlando, and Canada.
fantastic. I mean, V says, I've been here since the start of Mentor Club, man. He's been here for a long time. Pretty awesome from Taiwan. I had such a great time when I was in Taiwan. We got California in the house. We got Missoula, Montana in the house. Leela Clemenshaw shooting down the spy balloon in Montana. Was that you, Leela, that led that for us to shoot down the spy balloon? Lisbon, Portugal, Tampa, Jacksonville, Vegas, John Hamm, one of my favorite cities. I love Vegas. Mountain View, California. If I don't get everyone, forgive me, I'm spot checking here. But it's great to be with you, and we're going to have 2023. We're doing it a little early, and I'll let you know later on why we're doing it a little early. Usually we've done this in March. We've had a couple of Februaries, but we're doing the bulk of this in February for a reason, which we will unveil later on. But the fun part is, we never know what we're going to have year to year. We have no way to forecast. Like, I still got people talk, Vancouver, Australia. We still got people all over. Amazing. This is pretty cool. Someone says 2 years in Mentor Club. Ramon says amazing experience. We have no idea what the market's going to bring us. We traded. One of the memorable years was COVID, where it just flat out was coincidental that it happened when right when the market was melting down. We had, look, Newfoundland, way to be here, Randolph. We had
Where
we
is
had the market
where is Newfoundland? I should probably
last
know
year.
that.
Newfoundland, you don't know where Newfoundland is?
I'm gonna have to look that up. Where
Tell
is
you what,
Newfoundland?
I believe Newfoundland
Oh,
is
Canada.
like Nova Scotia area,
There we
like
go.
way like the north, like between Canada and you like up above Maine and
Yep.
like Nova Scotia area, I believe, is where it is.
Very cool.
Nottingham says it's right next to Old Foundland. Nice, nice. But we're starting off well. We had Fed, so I'm going to begin this 2023 with an assessment. What are we looking at this year? It's certainly not COVID. It's certainly not a runaway market. And right now we're in a really interesting time where the Fed is in a bit of a conundrum. We had massive inflation where last year we were looking at some inflation. We predicted we'd have big inflation, and that was certainly prophetic on Corey's part. And we did some fun things with some precious metals, which we might even look at again. And if I can just erase this, I don't even have a disclaimer. This is terrible. I forgot completely to have our disclaimer, so I'll have to find one. But what I'm going to start with here is just kind of an overview of how I feel about the market. I think it'd be critical to get Corey's view. I'll start, and then Corey, you can correct me or tell me
And
what
I
you.
just sent you a disclaimer if you need one. by the way.
I'm actually trying to find one on my, I'm not finding it here. I'm trying to find one. I usually have like a, a PowerPoint with one in there I can just pull up. Here we go. Thanks for sending me the disclaimer. This is an old webinar, so I'll use the one from this.
Perfect.
We're gonna use examples starting today, as we always do in the Quick Start Lab. We're gonna do some spread trading today, and these are examples for education, and it's risky. You'll see that since we're going to be more aggressive with these rewards than generally what we do in the, we teach in the 4 pillars of investing. We dabble into, more of the intermediate level, even some advanced options. Those of you that have taken the Ultimate Options course and also Noah's Playbook will be more familiar with these. Many of you, they'll be introduced for the first time. Maybe you've seen us do some in Mentor Club, but we're going to break them down in quite good detail. But you'll see the risk going up is the point. And so these risks will need to be managed and so forth. So with that, let's talk a little about the Fed, because I think you have fiscal policy, and I'm going to use the US simply because they're the world's reserve currency, and I believe that status is in question if that will continue to be the case in the long term. But you have fiscal policy and you have money, right? You have monetary policy, and this is about how they tax and spend and borrow, right? And this is very important. This is about rates and printing money, or quantitative easing. In other words, these two things affect the money supply. And what's interesting right now, obviously, when we talk about monetary policy, is the Fed has 2 mandates, and then kind of a third asterisk type mandate. They are going to use these tools of rate and printing money in an effort to have price stability. So they would like stability. I don't know how to spell stability. Price stability, and they would also like full employment. They want people working. And when you have price stability and full employment, the economy grows. And when you have unemployment, the economy sucks. A third kind of more silent mandate, they call this the dual mandate, but a third asterisk mandate is they would also like reasonable rates that are stable, rates that are reasonable and stable. But the problem is this is actually the tool they use to try to affect these. And sometimes, and I believe this is the case right now, is these are opposing goals. So right now, on the one hand, we have inflation, which it has slowed slightly, but not reversed. And it's not going to reverse, by the way. All these high prices, other than, gas will always go up and down, and fuel and stuff like that. But, the cereal box, the meats, the food, the grocery store, I predict those high prices are here to stay. They're not going to relent. They're just hoping they stop skyrocketing. And so what they're going to do is they're going to raise rates to try to get some stability to the prices. But that will get to a point where it'll affect how businesses do business. I mean, the money supply will shrink, and that means it's harder for businesses to do business, harder to get money, harder to get funding, harder to get loans. And you'll start to see the layoffs. And I've been saying this in the Mentor Club all winter, is my eye is on the employment number, because the Fed will really have a decision to make when the layoffs start to happen. Because if you have employment rise, have this full employment, that really can cause recession, perhaps even depression. And with the sensitivity of this, it's pretty tough. So the problem now is if you calm that rate hike because you need full employment, off go prices again. And it may be, time to pay the piper with all the spending and borrowing that they've done. We may be to a point where it's tough. Now, Jim Rickards, he's a friend of mine. Well, I wouldn't call him a close friend. We're acquainted with each other. He's been on my podcast, and he's a good friend. I think he's better friends with Robert than he is with me, Robert Kiyosaki, than he is with me. But I saw him. Did I tell you I ran into Jim not too long ago? We were getting on the same flight. It's like, oh my gosh, we sat across the aisle. We sat right across the aisle from each other in first class on a flight. It's like, Jim. He's like, oh my gosh. But anyway, he sells a lot of books by doom and gloom. So I always take what he says to heart, but with an objective lens. But he says we could have some rough water. My opinion in the short term, because of this employment stuff, I think they're going to slow these rates, and I think I'm slightly, moderately bullish in the next. In the short term, meaning like during the quick start lab, the next little bit. And we are often right when we do quick start labs. I'm hoping I'm wrong this year. It would really be nice. Like, it wasn't that hard to bat 1,000 during COVID because, it was pretty clear where things were going. We had clarity. And it really wasn't hard when our quantitative easing was out of control. That was pretty easy. This is a tougher one, I think, this year. I do. But I still think that some bullish direction trades are in order. So before we get into, and then I'm going to talk about two more things, then we're going to get into the first trade. I'm going to speak a little bit about rate of return and determining what rate of return you want to go for in your own life. How much is enough, how much is too much. And then I'm also going to talk a little bit about technical analysis in terms of predicting ranges as opposed to directions. But before I get into rates, and excuse my cough a little bit today, before I get into rates and ranges, Corey, would you like to comment, if you would please, on the State of the Union in terms of this stuff?
Yeah, so I've been bullish. We've talked about that with our coaching groups and so on, that I've been bullish, and I'll touch on this more. We'll talk about this as we kind of pull up some charts and things, but that for the most part has kind of run its course. I could see a little bit more upside in the short term, but I do think it gets a little bit more difficult. The analogy that I like to use is that we're kind of addicted to the drugs, and now we're off the drugs, right? And so there's going to be some changes that are going to have to take place, because that's really what QE is, right? It's basically stimulus. It's, hey, I can't hit the ball that far, so I'm going to take some steroids, which is going to make me stronger, and then I'm going to be able to hit the ball further. And now we don't have the steroids anymore, and my muscles start to deteriorate a bit, and I can't hit the ball as far, and I've got to adjust, right? My body doesn't recover as quickly, and so forth. And that's where the economy is. The economy is in this change where we have to get used to and dealing with higher rates, and we have to get used to the fact that the Fed's not going to be printing money, and we don't have interest rates at zero, and we don't have all of these kind of benefits that we had in prior years. And it's really, the Fed did, for the prior couple of years, one of the worst trades in history, in essence, because as inflation started to spike upward, they basically kept fueling liquidity. And so it was a stupid trade, because the risk to reward of it was so backwards. If you think about it, what was the Fed's benefit to having its bond buying program and all those things? Rates were already down at such low levels that essentially they were pushing on something that wasn't going down any further, but they just kept pouring more QE into the system, even as they saw rates spike. And so they were creating a bigger problem with inflation that now they're having to battle, and really there was no benefit. So they had a trade where they had very little reward, let's call it, and a whole lot of risk if they were wrong. And oh, by the way, they were wrong. They were wrong in dramatic fashion. Not only was inflation not transitory, as they had been suggesting, it ran out of control. And so now they've just had to basically take a sledgehammer to fighting that, and they raised rates. Yeah, pull up this chart. That's a great idea. They raised rates further and faster and by more than ever before in history in a single year in 2022. You look at that, we went from 0.25, basically 0% Fed funds rate to I
Dramatic.
guess it was 4.5 at the end of the year, and they just raised by 25 basis points last week, right? So from 0.25 to 4.5, that's a 4.25% increase in a calendar year. And why did they have to do that? Well, because inflation went out of control. So it's something that I think for a couple of years we're going to have to deal with. And so I don't think that this, by the way, that's good news. If you are wanting to build assets, which most of us are, right? We're asset acquirers. We want to buy more over time. Well, we should be rooting for prices to go lower because that means I get to buy more shares at a better value and so on. So it's really good news when you think about it if you're a net acquirer. But I think there is going to be some turmoil here for a while. I think it's going to be a couple of years here where we've got to get adjusted.
I think in the very short term, the market's going to react positively to the Fed statement of saying, look, we might not, do
they're
this.
kind of pausing.
Yeah, the fact that they're looking at unemployment and they're concerned about that number, that means the market says, okay, they're not going to withdraw these drugs, so fast and so severely. But I've never seen a hike with that big in that short a time. We're looking at 1, 2, 3, 4, 5, 6 bars. I mean, look at this: 1, 2, 3, 4, 5, 6 bars. That's nothing. So I've never seen a hike like this in my investing lifetime. I was in grade school, or excuse me, junior high school when Volcker and the Reagan administration took over the Carter after the Carter years and massive inflation. And I had an interview for those that are interested about this with David Stockman, who is a brilliant economist. He worked in the Reagan administration with Paul Volcker. And I had an opportunity to interview him recently on the podcast. That's an episode worth catching. And I said, David, I've heard, I don't know if it's true, but I've heard that when you get inflation past a certain point, that you would have to raise rates higher than the inflation rate. In other words, if the inflation rate is 8%, you're going to have to go to 8% rates to get it under control. If the inflation rate goes to 10%, you're going to have above 10%. And he said, I don't know if that's true. He says, well, that's certainly historical and factual. That is a factual statement. Paul Volcker had to do it. But the Fed seems to be taking, you can see this huge hike, and a smaller hike. The market in the short term will take that as good news. But so we'll probably do maybe some, bull call spreads, I would imagine, on, some precious metal maybe, or I don't know what we'll do it on. Corey will have this ready. But maybe some energy, I don't know. But I will tell you that I agree with Corey in that in the longer term, I think we should really have some dry powder for some bargains. And it is good news if the market suffers. I love it when the market suffers because I really don't care if there's much fluctuation in my net worth, if my cash flow is increasing and the amount of assets I'm buying is increasing. Because when you have an upswing after that, oh my gosh, it is a birthday party. So would you agree or disagree? There's been some activity in the market. They've been kind of happy about the Fed maybe balking a little bit, paying attention to employment, maybe slowing down. But necessity will be, I believe, if they don't keep raising rates, I think we get away from inflation again. And I think what Corey's really talking about is right here. This is the trade you were talking about. You'll notice that they were trying to reload their gun a little bit, and the markets were just getting killed right here. And so right here, they went to this thing called patience. Notice this is before COVID. This is before COVID. And they started lowering these rates even before COVID. And I think this is the area you might have been referring to, Corey, where they made a pretty bad trade. And then when COVID hit, it was just like immediately, okay, we're back to it.
Yeah, and even in that 2021 period, 2021,
didn't need to
is
keep.
where
Well,
inflation,
but
if you look at,
yeah,
yeah, and that's where they were really up with the transitory, and inflation had already spiked. Inflation started to skyrocket right there, and the
blame
Fed said,
COVID.
no big deal.
It's
It's
supply
just
chain.
transitory. It's just
It's
here.
supply chain.
It's
Yeah.
yeah, it's going to go away on its own. Don't panic. Don't worry. And during that period of time, they kept pumping liquidity into the system. So think about inflation running hot, and that's one of their mandates, is to keep price stability. Well, if inflation's spiking, that's not price stability, but they said, oh, it's going to work itself out. And oh, by the way, we're going to keep doing things that fuels inflation. So even as they were seeing the numbers and knew it was a huge risk, they kept pumping more liquidity into the system, which is just, it's bonkers, really, when you think about it. It's such a bad risk to reward because rates were already down in the dumps. They weren't getting any real benefit, but they were taking the risk that they were going to further the inflation problem. And sure enough, even as far into early 2022, they still had their bond buying program going, where they were pumping billions and billions of dollars back into buying bonds to drive interest rates down and so on. It was just a very weird time. The Fed has, I mean, they've said, look, we screwed up. Okay, we screwed up big time because inflation was not transitory and we made some bad decisions and so on. But it's this weird dynamic which creates huge opportunity when you can find that the market is not valuing something properly and not seeing the situation the correct way. That's really your opportunity as an investor, right? Or as a trader, or whatever it may be, is to find those areas that are not being valued, or the risks that are not being assessed properly, and trying to take advantage of those. So last year we were negative on the markets, for most of 2022. What's interesting, can I take control for just a
Yeah.
second? I
In
want to
fact,
show something that's,
we can throw that back and forth. I'll make you the presenter, or you
yeah,
can just
but
take it on your own.
let me see. I might be showing the wrong screen. Here I am. Let me bring it over here.
I've got
So,
a spinning rainbow on my side, so
okay.
there I
Well,
got
let me show something here that's kind of interesting. So, if you look back to 2022, this is the S&P 500. It was basically straight down, right? I mean, it was an ugly year for markets. This is the start of 2022, and almost from the time the calendar flipped over, prices and stocks went lower and lower and lower and lower. And this is that repricing where they said, okay, we got to reprice assets with inflation running hot. There's a problem, and stocks went considerably lower from 4,800 in October. We were down to 3,500, right? I mean, that's a huge drop. And in the Nasdaq, it was worse. I mean, that's 27% in the S&P. The Nasdaq was down 40, and so on. What's interesting is I've been bullish the past couple of months, and we've talked about this to our coaching group. And mid-December was a really interesting time. In the markets, there's fundamentals, there's technicals, and then in both of those, there is what we call sentiment, right? Or
you.
how people feel about things and how they're positioned and how much liquidity there is and so on. And so these are the two pillars, two of the four pillars that we emphasize in our 4 pillars program. There's fundamental sentiment and there's technical sentiment, and something happened in mid-December that was really interesting. Let me show this. I don't look at put to call ratios often because there's just frankly not all that much to really pay attention to in put to call ratios. But there was something that
There
happened that
is,
was,
in the fact that when it like Corey mentioned the word sentiment, and
mhm,
sentiment is simply, well, how do people feel about things?
yep,
And when people feel good about things, they want to buy some calls and speculate. When they feel bad about things, they want to get
buy
some
puts.
return, get some puts. Yeah.
Exactly. And so it really is a sentiment guide, and normally it's just kind of in here where it's not. Let's just kind of draw some ranges here, and you say, well, it spends most of its time in here. It's kind of like the VIX. in that the VIX, we call it the fear gauge, right? Most of the time, the VIX is just kind of doing its thing, and we're not, we're not watching it closely every day, like, oh, the VIX went up a tiny bit or it went down. We just don't really care. But on occasion, the VIX will give you something that shows sentiment and says, hey, people are turning really cautious or they're getting too bearish. And so we look for these extremes. Look at this 20+ year chart in the put to call ratio. And what this simply is how many puts are traded versus how many calls are traded.
Yeah.
Now, an extreme high reading in puts would be up here, right? Look at what happened in December of 2022. Put to call ratio exploded higher. A high reading was like,
and that's
120.
that's a
It went to
logarithmic
240.
scale. That's a
Yeah.
logarithmic scale. If you were to put that to linear, it'd be through the roof.
Yeah. So it's extreme, right?
Yeah.
What did this tell us? Well, basically, the market participants were loading up on puts. They had bought so many dang puts. Now, here's something to be aware of. In the options market, the front 2 months are important, okay?
Yeah.
So if this was December, mid-December, what are the front 2 months? Well, they're January and February.
Yep.
Stocks will always have the front 2 month expirations. They won't always have a third or a fourth. It'll kind of be hit and miss. Like one stock might have Jan and Feb, and then it skips to April. Another stock has their January and February, and it skips to March. When January expires, they'll create a March. When March expires, they'll always give you the front 2 months. So if this stock doesn't have a March, it would after January goes away and so on. The reason that's important is if the put to call ratio exploded in December, most people trade, most of the day-to-day volume in options is in the front 2 month expirations. So what were they trading? They were trading and loading up on a lot of January puts and a lot of February puts, okay? January, I don't remember what the expiration was. It was like the 21st, and February 17th is the third Friday expiration. So for options, the third Friday is what we call the monthly options expiration. So if they're loading up on puts, they're loading up on these two. That's how you can look at this. Okay, what are they buying? What are they loading up on? If they own a ton of puts, sentiment is so bad, it actually is a bullish signal, especially this type of extreme. Now, why is that the case? It's kind of like the old saying with the VIX. When the VIX is high, it's time to buy.
Time to buy. When the
right?
VIX is low, it's time to go.
Time to go. And what that old saying with the VIX means is when the VIX has a super high, crazy spike up, and then it gives you some, high, like the VIX has just been exploding for weeks, and then it just kind of turns vertical, and then it gives you this like long upper shadow, like a big shooting star like this. It tells you that the VIX has just basically exhausted to the upside. The nervousness has reached a crescendo. It's like this big exclamation point that says, wow, the VIX just reversed massively off of the highs after it's been skyrocketing. When the VIX is high, it's time to buy stocks. People are so negative, so pessimistic, it's time to buy. Here's the same reading. This is the same type of idea. When put to call ratio gets super high like this, it's time to buy. Look at the last time we had a massive spike. Happened to be March of 2022. What was in March of 2022? COVID, and stocks had collapsed in price. Was that a good time to get bullish at the end of March in 2022? It was like the best time, right? And so in December, we had an even higher put to call ratio spike than in March of 2022, which was really interesting. Part of the reason it makes stocks less likely to go down is because the market was insured. It was protected. If you are a hedge fund manager and you own a bunch of stock, but you also own a bunch of puts, you don't have to sell if as the market goes down. As the market goes down, they might be apt to sell their stock or whatever. Well, this protects them. This insures them. It makes less selling pressure for stocks because there's so much protection and
Right.
so much speculation on the downside, right?
Right.
Now, the market's more vulnerable if there's not a lot of put protection, because then as it starts to fall, they got to sell their stocks or go buy puts or whatever. Since the market was so nervous, it's basically everyone was piled into this nervous bet that stocks were going to fall. There was also some other interesting readings. There's surveys that they do of like investor sentiment, and people were so negative on the stock market. And there was more stocks sold, I think, in December in individual brokerage accounts than like ever before in history. It was just basically in December, for whatever reason, everyone got negative and thought, oh, we're going to crash again. Here it comes, which was a very bullish reading. So if you look at the stock market since then, we basically have spiked up. This was a perfect kind of buy signal, and we've gone up 10% or so in the S&P since then. But look at when these puts run out. January puts have already expired. That insurance is gone. February 17th is just 11 days away. Those puts are going to expire and be gone, and the market's back to more of an uninsured position. In mid-February, so again, we got a little bit more room, and we're probably not going to collapse immediately or anything. We got a little bit short term, probably choppiness, upside, whatever. I don't know exactly how it's going to go, but start to get past February 17th and things could get a little more ugly, a little bit more dicey. There could be some more aggressive selling kind of coming into the markets. When you look at sentiment and you look at these protective puts expiring. Now, don't get overwhelmed if you didn't understand all of those key points. Don't freak out. We're going to go through this in a number of different ways. We're going to look at all of these things and kind of talk about them. But I thought that was very interesting how sometimes you'll just get these signals in the market that are very powerful. And so, it's something to be aware of, something to kind of put into your watch list, into your checklist of things that, hey, if we get a crazy high reading, I know that it can be a counterintuitive kind of buy signal. Like the old saying, when the VIX is high, it's time to buy. When the put to call ratio is sky high, it's also time to buy. That's kind of the idea there.
This is a poor analogy because I don't want to be insensitive. All of us have people who have had family members, friends, maybe even ourselves suffer with some type of addiction. But if a person is addicted to heroin or meth or whatever, and they get into the clinic and they get sober, it's a painful process when they withdraw those drugs. If he escapes maybe and falls off the wagon, gets a little hit, he'll feel better for a moment, but in the long term, it's still going to be very, really rough. And that's kind of how I feel about this with the QE and the Fed right now and this sentiment. Let me take it back, Noah or Corey, and let me ask a couple things of you right here. I was speaking, as I've said before, mentioning David Stockman, and we were talking about this runaway inflation. And after we were finished, we had a conversation. I was talking about a chart, and he goes, "Hey, send it to me." So I emailed a chart to him that I build. And some of you have seen this before, but I haven't showed it in a long time. And just in the question box, how many of you recognize what you're seeing? Just say "Yep" or say "New." Just want to get a feel of how much I might or might not spend with this particular group. Of saying "Yep, I understand this," or "Oh, this is new." And let's just take a poll here. Mostly new. We have a few yeps. I'd say, golly, I can't even. Oh man.
Probably 80% new at least, or something.
I can't take a full sampling, but
that's a lot of yeps and a lot of news.
Yeah, a lot of people today. Let's just look at this here and open the clipboard here. We got a little yep, new, yep, new for me, new. A lot of news right here. A big block of new right here. So this is one of my favorite charts. You have to build this yourself. You can find these four at the Fed individually at the St. Louis Fed is where you get these. And you can build them yourself for free, but you can't, it's tough to build all four because you got to get it in millions instead of billions and sync it up, and it's a pain in the neck. But you can't really get it, and I've never seen anyone really build this. I'm sure other people have. I've just never seen anyone other than me do it. But what this does is it gives you a perspective on what Corey was talking about with why he says, I think we could be in for some turmoil. So let me kind of go through this, and then after that, we've set the stage to talk about how Corey and I feel about the market. And this is a very important part of this year's Quick Start Lab, because part of when we advertise this with people, that we say, well, why should I come to an event like this? Well, because we don't know what the market's ever going to give us each the year to year, and you'll kind of see how do we deal with this, and what are the metrics and the things we consider. A lot of you have been, I can't answer everyone, but some said, hey, what about the stimulus package? What about this and that? So let me kind of show you something. If you go back, 20 plus years, and you look at Fed policy, this graph is really weird, isn't it? I mean, all you really have is a sea of blue here with tiny little specks of red, and that's about it. A sea of blue and tiny little specks of red and green. And the reason that is on the Fed's balance sheet, their liability then was simply currency in circulation, the money supply, and all this other stuff was pretty much minuscule. They just managed the money supply. Well, the gray area represents recession, which we hate. And when we hit the recession, they took a year to change legislation. And in that year, of the subprime meltdown, they changed what the Fed could do. And this was really interesting. They said, look, we will absorb a lot of bad debt, a lot of mortgage-backed securities. We had this insane subprime meltdown where all of these subprime mortgages were gonna default. It was gonna take down the banking world. It was too big to fail, and the Fed said we need to buy all this bad debt because we can print money to absorb it, and they can't. And so they did that. And part of what they did is they said, we're going to start, watch this, we're going to start letting our member banks, or what we call depository institutions. Now, what is a deposit? This is hard for people to learn because there's so much damn jargon in this. A depository institution would be like a member bank, Citigroup, Lehman Brothers. They didn't quite make it.
JP Morgan Chase.
Goldman Sachs, yeah. And what they said is, we will take money from you and we'll put it on deposit and pay interest on it. And they have this interest rate that they pay on it. That did something really interesting because it gave the Fed control over the banking industry and put a floor on rates. Let me explain why this is important. If I'm going to loan money to my brother-in-law, he might not maybe pay me back, so there's risk. So let's say my brother-in-law says, I'll give you 2% interest for this risk. But the Fed turns around and says, Andy, we'll give you 3. Well, if I give my money to the Fed, I know I'll get it back because they can print it to give it to me. So there's zero risk theoretically in loaning money to the bank. So what that does essentially is say, my brother-in-law's out of luck because I'll put my money with the Fed at 3% before I'll loan it to him at 2%. So they effectively put a floor on interest rates, not by decree of law, but by policy, by saying, look, you can put your money with us risk-free. Why loan it out to mortgage, people if you can save it with us risk-free?
And this is how a lot of times investment decisions will be made, is they'll do a comparison like you're talking about of the risk-free rate of return versus what this other one has with risk and whether it's worth it, right? And so when they refer to risk-free rate of return, they're saying money at the Fed, treasuries, those sorts of things, because the US government can print money to pay off their debts.
Okay, so give me a little yes if you understand that now that people could actually put money on deposit at the Federal Reserve, like a real bank, that would be a competitor against all other lending in the world. How many understand that? Say, yep, got it. Beautiful. Okay. Oh, you're beautiful. Got a couple of sort ofs, but yeah, it's just since the Fed will let you save money with them risk free. If I'm an institution, I have $1 million. I can loan it to people to buy houses where they might default, or I can put it on deposit at the Fed like a savings account, get paid interest. Either way, I get paid interest, either to save it at the Fed or to loan it in the market. And so if I can get Fed at, like right now, let's say they're paying 4%. That means, a home mortgage has got to be more than that because it wouldn't make any sense for an institution to give anyone a mortgage for less of a rate than they could get at the Fed. Well, you'll notice something happened here in 2009 is that the government would borrow money, massive amounts of money. The government would borrow money, and they would buy the bonds that the institutions held. So in other words, if the government wants money, the institutions will loan it to the government. Then the Fed will, and so now the government has cash, and the institutions have a treasury bond. Well, then the Fed will turn around and say, hey, let us buy your treasury bond and we'll give you cash. And they'll take that cash and they'll put it on deposit at the Fed. Isn't that nuts? So this red area, this new frontier we're in, we're pioneering here, basically. We're pioneering the idea that a central bank can pay interest that they print out of nothing, right? The interest rate they can print out of nothing. And there's this massive spike. Well, the whole idea, and this is what should scare you or excite you, depending on your skill level. What this did is it essentially doubled the money supply from about 800 billion dollars to about $2 trillion, because this is in millions. So that's 2 million millions, which is $2 trillion. So going from 800 billion to about 2 trillion right here. And the idea was to unwind this. The idea was it was temporary, right, Corey? We're just in the middle of this recession here, and we're gonna get this back down to normal and return back to this stability down here. That was the idea that they had.
Yep.
But because the money didn't really go in circulation, most of this money stayed it's not in circulation, it's on deposit at the Fed. That inflation was very, very slow to happen. There just wasn't much. And then they had QE1 and QE2, and right here I thought they'd really go, and then they went to what we call perpetual QE, which was printing, borrowing, printing. And around the year 2014, this started to get really weird. So I'm going to divide this story up into chapters of chapter 1, before the Fed went crazy, chapter 2, when the Fed went crazy under Ben Bernanke with these rounds of here's a $50 billion and here's $50 billion and here's just $50 billion a month perpetually or so, whatever it was. And so then we had this interesting, just this insane amount of spending. Now let me show you the green. The green is the Treasury's bank account. So the Treasury's checking account is at the Fed. So when the Fed or when the Treasury would borrow money and sell bonds, that's how they borrow money, and sell T-bills, they would take the money they get from the institutions and they put them in this green account here. So basically these are the 4 accounts at the Fed. The money in circulation is counted as a liability in 1. The red is these deposits by JP Morgan and others. And the green is the checking account of the government of the United States. Okay, now watch this. So we see more green here than we ever saw before, and lots of green maintaining fatness here. We are winding down, good, we're winding down some of that money on deposit, but look, it's leaking into circulation. That's going up. It's leaking. This is getting bigger. So what I see here is I see money moving downward away from the Fed, but leaking into circulation, which is inflationary. Now, the most important part of this story, I think, that's really interesting is there's two places, is right here. Before COVID hit, they started lowering rates and raising this back up. They started taking this V right here where they started increasing the QE, and you can see it by the depository. And then COVID hits, and then we have another chapter. We have the holy smokes Batman chapter. So before the policy change, the nuttiness of Bernanke, the craziness of Yellen and Jerome Powell, and then the COVID years, the COVID time. 4 very astounding chapters. And what takes my breath away, Corey, whenever I look at this chart, what takes my breath away is that, you know, it doesn't, for me, an old man like me, 2008 wasn't that long ago. To me, I'm an old man. And to think that, like, if we could have had binoculars to see in the future and said, if we start this mess, we're going to be at 8 trillion. We're going to go from 800, we're going to have a 10-fold increase, 10 times the printing. It takes the breath away. And so you can see that right here, we have massive amounts of borrowing, because that's the Treasury's coffers. They borrow all this money, and look how fast it goes to nothing. It goes to nothing. And the depository institutions gets really, really rich in this area. In other words, it goes from here into here. We borrow it in the green, and then the Fed buys those bonds, and there they are back in the Fed's coffers.
How does the Fed see this huge increase in money supply and so on, and not get nervous about inflation? Because by its very essence, inflation is basically you have too much that buys too little, right? It's basically that your dollars are losing their purchasing power. That basically it's kind of
inflation.
It's dilutive, right? If they print more and more money, each dollar loses its potency. It loses its value because there's so much in circulation that the goods prices go up. That's what inflation is. We can't buy as much as we used to. So how do they see this in trillions of dollars and not see that inflation was going to be a huge risk? Yeah.
When what they saw, what they were looking at, really, if I could, I don't even know how to show it. I mean, they were just looking at this much, and this was the world. And I don't think anyone had any idea we'd have this. Now, this is interesting. Is this too boring for you guys? But if this is interesting so far, say this is interesting. Because this is really how we make these decisions. And if it isn't clear, you know, you can always, we record these. Make sure my recording button's on. That would have been a tragedy. Okay, this is like high level stuff, right? High level stuff. So I'm going to speak to you about this purple area, which is the reverse repurchase agreement. All of the red are member banks. In other words, you can only be a US institution to be in the red. You have to be a national bank, or you can apply for membership as a state bank, or if you're a large commercial bank, you have to be large multi-state banks have to be members. You know, there's thousands of these. But there's also 2 big areas. There's these funds called money market funds. Now, let me explain what a money market fund is. A money market fund is where I keep cash to buy stocks with, and it goes from cash to stocks and stocks to cash when I buy and sell stocks. And the money market fund is important because it theoretically have to be as close to zero risk here as I can. In other words, if I have $10,000 and I sell stock, $10,000 worth of stock, and that $10,000 goes liquid now, and I put it in a money market account to keep it liquid, I expect $10,000 to be there tomorrow, right? You know, I don't. Savings accounts aren't liquid. They don't like you to move that money, because in a savings account, they want to loan that money out to somebody, right? They want to make it into someone else's, house, like, It's a Wonderful Life, like, the Bailey Building loan. So the Bailey Building and Loan in A Wonderful Life, you can't just show up and say, I want $242, please. Well, I can't give it to you. I don't have it. It's in, Potter's, house or whatever. So the money markets have to be liquid, but they also have to be safe. So money markets generally will only borrow or only invest in short-term stuff that gets them liquid again, namely U.S. Treasuries and well, I say low risk commercial paper, right? Really highly rated commercial paper. Well, the problem is if they can't make money as a money market, they're going to do what's called breaking the buck. In other words, that money market might become lower than $1. Now, this is important for the crypto world, because if the Tether and the stable coins act like a money market to the crypto, so this would be a stable coin and this would be crypto, and it's the same thing. Stable coins sit there like Tether, and right now Tether's being investigated for good reason, because they've been proven to be liars, totally proven to be liars. And if they can't make money with that money, they could break the buck. So the money markets, they have commercial paper, they have treasury bonds, and they have another thing they can do. They can have a third key, which is reverse repurchase agreements, which simply means that if Corey was a pawn shop, and I took some of my tools to Corey, I'd have to actually give him the collateral, and he would give me cash with the agreement that I could repurchase those later on, and he would make a profit. So instead of it being collateral, it's more like pawn. And so what happens is these money markets can actually do repurchase agreements with the Fed, where the Fed agrees to buy them back at a higher rate than they were sold overnight. And it's overnight, so it's liquid. So that allows money market funds and now international banks to get a rate from the Fed as well. So look at this. Here, they took over the commercial world of lending, because now a member bank would have no incentive to loan money at risk if they can get a rate at no risk. This is where they took over the rest of the world, because now any international bank or money market fund can now do business with the Fed at a certain rate, risk-free, and that puts a floor on the world's, check this out, on the world's interest rates. It's global. So the Fed essentially has taken over the world in terms of risk-free rate, and now they are a competitor to the entire planet Earth. So if I live now, I'm not a member bank in the red, I'm not a US depository institution. Now I'm in Taiwan or Vietnam or Croatia or Venezuela, anywhere in the world, and I can now do business with the Fed by saying, well, yeah, I can't put money on the Fed in their savings account, get paid this risk-free rate, but I can engage in reverse repo agreements. Therefore, why would I loan money to anybody else at a higher rate than what I can get at the US Fed? So this is a really important discussion, and quite frankly, this chart takes my breath away. This will not be shown on the screen in any of the presidential debates that we'll have to endure in the next 2 years, because neither of them would ever want to complicate it for the people, and they certainly want to talk about this incredible change. So basically where this lands us is we have a Fed who has taken over the rate market. They control that now, which is maybe good or bad. You can see here, lastly, is that they almost ran out of money. The green got very, very tiny, and then it expanded again. Now it's getting tiny. Well, guess what? Excuse me, I apologize profusely for my terrible cough. Well, guess what's happening now, right? We have a debt ceiling fight every once in a while because we need to borrow even more because we're out. See how it's getting skinny again? We borrowed a bunch and ran out. Now we've borrowed a bunch, we've run out. We need more money. So we got to take this higher again, which takes this whole thing higher again. And all of these, the blue, the red, the purple, and the green, would continue to get higher and higher and higher perpetually because of the debt
Yeah.
and because of the
And you know
spending
what's
of the U.S. government. So,
what's kind of interesting about this, Andy, is a lot of times when you have these discussions, it can make you really pessimistic and negative. But I would almost flip that and say it's part of why I love stocks is because I want to get out of US dollars, because I
yes,
want to own productive assets, right?
yes,
So
yes, I want
so
to own
there's
Apple. Yeah, I want to
yeah,
own something that is producing something, not something that is printed out of nothing. I want to hold an ownership real estate stock. Very true, Corey. Good point. Now, with all this money, I think there'll be so when I say I'm moderately bullish in the very short term, I'm talking the very short term. And when Corey and I say we see possibilities of turmoil here, we see a snowball that's being rolled up the hill, and the more potential energy it has as it gains mass, and the snowball gets bigger and bigger and higher up the hill, the more headache this could bring, and the more opportunity for you and I to own incredible companies on the cheap when when inflation happens, or excuse me, when deflation happens. We can get bargains um, by buying these on the cheap. So with that said, let's talk about rate now of return. Let's talk about our opportunity with the sediment. What can you just summarize that big mess we just did? This will set up all. It's worth the time we put into it, guys. It's worth the hour we put in the first hour to set the context of where we feel we're going to make. We got to have an up, down, or sideways here for this year's Quick Start Labs. We have to have sentiment. We have to have market opinion. Mine is maybe down the road we could hit some problems, but as Corey mentioned, put call ratio, all these things, the Fed backing off. I mean, what's your sentiment, Corey, for this year's Quick
yeah.
Start Lab? Up,
So
down,
I would
over the
And
next
I would kind of call myself in the short term, I'll call it more neutral on the markets, wanting to find, I think there's going to be bullish and there's going to be bearish areas.
right,
In the intermediate term, let's go out a few months, I would call myself more bearish in thinking that we're going to have still some further, you know, wood to
right,
chop, so to speak. We got to deal with some of these problems. We got to reduce money supply. I think the Fed's going to stay higher for longer in terms of interest rates and Fed funds rates and so on. So I think there's some good opportunities there. By the way, we can make money as markets go sideways. We can make money as they go down. We can make money as they go up. So that would kind of be my short to intermediate term outlook. And then long term, I'm always bullish. I mean, it doesn't pay to bet against the stock market long term. That has not put it this way, in the time that anyone within the sound of my voice has been alive, it has not been in your favor to bet against the stock market long term. In the short term, sure, there's been pockets and opportunities. In the long term, I'm always bullish, thinking that in the coming decades, the S&P is going to go to 8,000, then 12,000, then 16,000, and so on.
So I'm very mildly bullish. Corey is neutral. Our outlooks are very similar. The only reason I think we could see and this is not to scale. This is very short, and this is immediate, and this is long term. So this is shrunk, like that, or however it is. We're very much in sync. I think the reason I think we might have a little bit more to squeeze out here is I just think the Fed is afraid of unemployment, and I think the market believes that, and I think the market thinks they might get more medicine possibly, but they'll be skittish about it. They won't be definitive, and so I think what we want to do here is we want to find trades. COVID, we were like, yeah, baby, let's be bearish. During the QE, we're like bullish. We gotta be bullish. This year, we're a little bit more neutral, a little bit more of a sideways idea, with me being a little bit to the upside, Corey being neutral. I would go with Corey every time because he's smart.
No,
Uh,
I get it wrong plenty, and that's the beauty of risk management is We don't need to be right
Need to
all
be
the time.
right, yeah. But I do want to own equities and own stocks. So with that in mind, I'm going to speak to you now about chapter 2 here. I said I was going to talk a little about rate. If I have a financial statement, there's two rates I'm concerned with. There's a growth rate, a percentage, a growth rate of my asset column minus liabilities is net worth. So I want that to go up. And then these should spit off income. And this percentage return on investment is what I would call passive income or an income percentage. So let me kind of put it to you this way. If someone says, okay, I have $1 million in asset. I want to have $200,000 a year in income, and I want to have this in 10 years and retire. So I start with $1 million. Maybe someone has much less than that, whatever someone has, and maybe he starts with a goal of 200,000 passive. Well, you have to determine two rates of return. What rate of return can I get on this for growth over the next 10 years? And then what rate of return can I get here in terms of income? So, 200, that would be a 20% rate right now. So I got to grow that a lot more. And maybe I change to 11 years or 15 years. So one of the things I like to do when I'm in a live group, and I haven't ever done this with the Cashflow Academy, but I'm often asked to speak as a guest speaker, to do a financial speech or a workshop or whatever. I've never done it with my own students because I like doing things over the internet. But I help people figure that out. Like if you want a real blueprint, okay? If you want a real blueprint, okay, you've got to have these numbers down, and there's several here. There's the time number, when you want to retire and be done. There is the income rate. What are you going to get out of your nest egg after that 10 years to where you're 90 and 100 and dead and gone? It's a legacy. How much money? There's an amount here that you're starting with. There's an amount here that you need to end with. There's an amount you're asking for. There's a rate, and then there's a growth rate. So think about that. The time number, the income rate, the income amount, the amount you're starting with, the amount you'll need, and the amount you'll need to grow out. That's a lot of numbers to wrestle with. And one of my favorite things is to sit down and, as a group, and it's diverse. Everyone's going to be different. They're going to have different amounts, different goals, different needs, different times, different rates. And as you increase rate here and here, you increase risk. And so you have a choice to make. Do I want to manage the increased risk or do I curtail these numbers, or do I curtail and put it out in more time? And you have to tweak. The balance of your blueprint is a balance of time. It's a balance of lifestyle goal. It's a balance of risk, and it's a balance of how much education. More higher goal, less time, higher risk, higher education for the management. That's how that works. Does that chicken scratch make sense to anybody? That for a true blueprint, you should reverse engineer these two rates of return: the rate of growth and the rate of income that you have, based on how much time and your amounts to start and end with. Okay. And that takes them, actually, there's the math is pretty easy, except for getting this growth rate. That's the hardest one to figure out and reverse engineer, and it takes a little bit of math and algebra to do that. But it really helps, because now what I need is when I land on this, now I'm not just investing arbitrarily. Okay. I'm not just saying, well, I'm just going to buy some stock, make money. I say, look, I need a rate of return right now, and I need to maintain that rate of return in a certain number of years. So let's say someone has a 15-year time frame before they want to be done and retire. Another guy says, no, 5, man, I'm out in the rat race. I'll take any risk I have to, right? Whatever your personal preference is and your education to manage it. So, for example, I might draw 3 financial statements for 3 different persons in a workshop. And I might say, okay, we have, John, Sally, and Sarah or whatever, John, Sally, and
Oh, I thought you were talking about the old Detroit Piston, John Sally.
okay, John Sally. Oh, he's a fowler, I'll tell you. So maybe this guy says, look, I'm going to own stocks and I want a dividend. Maybe my dividend on is like 5%. That's all I need. I can retire right now with what I have, and I never have to trade another stock again. I go buy some I don't know, some Verizon Wireless, and they pay a 5% dividend, and I think that company's getting around. I like those risks. The risk is there'd be obsolescence risk, competitor risk. There'd be risk of recession where they don't there'd be a technology that surpasses cell phones. There's risks, but there's also pretty comfortable idea maybe that whatever the dividend is, I can live on it. Okay, maybe another person says, I want my stock and I want the dividend at 5%, but I also want, maybe another 1% a month. So for 10, maybe I lose some months, so maybe another, 8% I might get on covered call writing for a total of 8 and 12 is 13%, maybe something like that. But maybe someone over here says, well, if, I can't make it on that. I'm old. I didn't compound well. I didn't grow up like Andy's kids. My kids started compounding at age 13 in stocks. And if you look at age 13 in a compounding calculator, it's ridiculous. They need to get about 8% to take over the world. That's all they need. And the S&P has done 10 easily over the last few years. So, they really don't have to be that smart. They just have to get in early and be consistent and disciplined for, in my opinion, do very, very well. But they start when they're 13. You start when you're 55, crap, lost all that time, didn't get it done. So maybe Sarah is my age, right? She's a little older. What rates does she need to go for? And most importantly, what risks are there? So, part of the power of this is when people come to me with a bad question and they say, well, hey man, what rate of return do you think I should be going for? Well, it's not like that's like asking me what type of ice cream you should buy. Well, buy what you want. What do you want? What do you want to go for? How much ice cream do you want? What flavor? You have to decide that. It's not me. And so this really helps people start to think about what they need to do in terms of study, discipline, consistency, risk management, that way. Now, here's a problem. You can't force the market to go up or down. You can't. So problem number one, can't force. Well, can't force it. Can't do it. I can't buy a stock and force it up or down. So that isn't going to work. I can't force it. Okay. Number two, even harder, less effective. You can try this. It doesn't work as well. It's really hard. It can be done, but it's not real easy. It's hard to predict the direction. So I may say, well, I think it's going up. That's my sentiment. Like Corey and I just did. We think it's going sideways right now, and that's our sentiment. Okay, but what you can do, so this is control, which you have none. Okay, this is direction, which is hard. Direction, which is hard. So number three is what I like to often do, is say, well, I might not be able to force the stock up or down. Might not be able to choose direction, but you know what I can do? It is relatively easier, not easy, but easier, simpler to choose a range. Where I say, look, I don't know if it's going to go up, I don't know if it's going to go down, but I do feel it'll probably stay within this range somewhere. And so where Corey and I have a sentiment where we are, neutral to bullish, we probably say, let's bet on a range. And let's see if we can keep a stock within a certain range before we start seeing significant risk, and we still will take on more risk doing this actually. So we'll come up with a mix in this. If we take this range approach, we're going to have to identify three things. Number one, we're going to have to identify if our rewards are conducive with our blueprint. In other words, if a covered call can't get the job done, or an easy dividend can't get the job done, I'm going to consider, or at least explore, more aggressive rewards so I can not give up on my dream. Number two is I absolutely need to understand the increase of risk and plans to manage that. And then number three is, what are my probabilities of success in each trade individually, and what it might translate to collectively. And if I have rewards that are sufficient and risks I feel I can manage and probabilities, there's never the word guarantee in any of those three, but maybe I have a blueprint. So what have we learned so far in this first 90 minutes or hour and 10 minutes? We've talked about the Fed. We've talked about the environment. We've talked about these charts and graphs and these policies and where we think things are going. We've talked about the need for an individual blueprint for two goals: a goal of growth. This is an amount where I am, amount initial. This is the amount I will need in a certain amount of time. And there is a rate of growth I must achieve to have a certain amount in the asset. And then this must generate a percentage off of this final number for income. And that's an income. We'll call that amount income. So you have amount initial, amount final, and the amount of income you need. So that's, how many numbers is that? Really, that's 1, 2, 3, 4, 5, 6 numbers. And if you are clear on those 6 numbers and you know what they are, now you can determine where you are in this. Are you in this rate now? Are you in this rate now? Are you finished with your time or just starting? And I think it brings some definition to your blueprint and what kind of assets, real estate, stocks, options, business, that you can go after. Okay, is everybody with me so far? Yeah, and you know what? Sean states the obvious with the ice cream question. It's Haagen-Dazs. And for him, hey, it is strawberry. For me, it's New York Super Fudge Chunk. Oh man, makes me cough thinking about it.
Now my kids call it Jen and Berries.
Jen and Berry. I almost named
Jerry's, but they're big fans of Jen and Berries.
I have 2 sons. I almost named them Ben and Jerry. Marcy wouldn't think of it.
Yeah.
So with that, I'm going to make Corey the presenter. I'm going to rest my voice for a minute. And what I'd like you to do, Corey, is find a stock, Canada. We're not going to do all 4 pillars because people have already been through that. Find a stock and let's show those 3 financial statements. Say, this is what you get from a dividend. That's 1%. Okay, this is what you get from writing a covered call on top of it. That's a percentage. And then see what the percentage is with maybe a spread where we look at a range and maybe a leaning of direction, but really more of a range along with that direction. And the purpose of the, man, everyone's putting out rum and raisin. We got everyone voting with their favorite ice cream. Makes me want to go have some. So I'm going to mute up for a minute and quit coughing in everyone's ear. Corey, take it away.
You might need to get some ice cream to soothe that voice.
While you start, maybe you start a little ice cream might do the trick, right? Just might.
So check this chart out. We won't go through all the 4 pillars, but you can see technically this goes back many, many years. And this stock is Occidental Petroleum, and that's what we call massive resistance. How about more than a decade-long resistance here? Occidental Petroleum is kind of interesting. You could also draw a trend line right here and it's in what we call a consolidation pattern. See how it's just going sideways, bouncing back and forth here. A lot of times this is an ascending triangle. A lot of times the resolution of this is up and out. And so that would be a mother of all breakouts up above that level, and it could run higher. Fundamentally, it's kind of interesting as well. Just quick overview. First of all, its earnings are just fantastic. Its numbers, we won't go through all of it, but really quickly, you can see their revenue numbers. These are quarterly and just robust. You can see their earnings, profitability, okay? Just fantastic. And to put this into perspective, we don't have the full 2022 numbers, but if you look at 2021, they had 25 billion, 26 billion, we'll call it, in revenue for the whole year. Okay, 26 billion for the whole year. That's the top line. That's money coming in from customers, right? And their profit was 2.3 billion. That was the actual profit after paying the employees, all expenses and so on. Let's see what their numbers are on pace for in 2022. Check this out. They had revenue of 8, they had revenue of 10, they had revenue of 10. So right there, that's 3 out of the 4 quarters that so far have been reported, and we're at about 28 billion. So in 3 quarters, 3 of 4, we're already above the 2021 total, and we're missing 1 quarter. We're going to probably be around 38 billion or so in revenue for 2022. Look at profitability. Okay, 5 billion in profit, 4 billion, and we'll call it 3 billion. I kind of rounded up, but let's go 5, 3, and 3. How about? So 3, 3, and 5, that puts you at 11 billion in profit. And again, that's in 3 quarters. We don't even have the 4th quarter yet. They're probably going to have 15 billion or so in profit this year compared to 2021, where they had 2.3 billion. So fundamentally, is the company getting better or worse? Has it grown? Absolutely. And it's pretty rock solid that way in terms of the growth in 2022. Now, we have to assess the future and say, okay, well, what is 2023 going to bring and so forth? But those are things to pay attention to. Now, let's go over here and take a look at what Andy talked about. If I go into Yahoo Finance, it's just a free website. By the way, I was using Google Finance for this little quick chart. If I go into Yahoo Finance and I click on the statistics after putting in Oxy's stock symbol, I can come down here and look at its dividend. Now, its dividend is not huge, 52 cents a year right now, which, by the way, they raised by 12 cents, and I would anticipate another dividend hike. They announced earnings late this month, I think on the 26th, 27th, something like that, in a few weeks. I'd expect probably they're going to raise their dividend. So it'll probably be around 1% or so after they raise the dividend. That's an educated guess. It's not there yet, but they're around 1% with a dividend hike that I think is coming. That's not really sticking my neck out there to guess that that's going to happen, because again, we just saw they have a lot more profit to divide up to shareholders. Now, at 1% dividend, if I buy the stock, that's not a huge amount of profit, is it? I mean, it's basically, let's write it out this way. This is just buy and hold of the stock, and I get 1% per year, and then whatever the stock appreciates. So if we think about our income, we're getting about 1%. Well, that's about, it's going to be raised up here, I'm guessing. Let's call it 60-ish cents. 60 cents or so per year in dividends. Now, this is what gets really fun in investing. As we bring in income, we can take that and start buying more assets, right? We can go buy a few shares of this or a few shares of that. as dividend and income payments come in. So that's one opportunity, is just buy the stock. You'd collect around 1-ish%. Now, the next idea would be buy and covered calls. So we're saying, okay, we're going to collect the 1% in dividends still. So that's going to be a part of the income, right? I'm still going to collect. And again, I probably should just stick with these numbers. It might get confusing. Let's not jump the gun here. It's only paying us 52 cents right now. Let's just stick with that. So 52 cents per year. Okay, we get that, but we can probably bring in additional income from covered calls. Now, what is a covered call? Quick intro to options. You're going to hear a lot about options in the next few weeks. But here's a quick introduction to the options market. Take a screenshot, take a snapshot, take a picture with your phone. But these 4 definitions we're going to come back to over and over again. There's only 2 types of options in the options market. There's calls and there's puts. That's it. And you can do one of 2 things. I can buy a call or I can sell a call. I can buy a put or I can sell a put. That's it. That's all you can do. So any advanced option strategy is just a combination of these different things. Now, here's the definition of what you're actually doing. When you buy a call, you are locking in the choice. What's another word for choice? Okay, how about you have the right, you have the ability, or the magic word option. You have the option to buy the stock for the strike price amount at expiration. It's up to you. Okay, notice that with buying, you have a choice. See, if I buy a put, same thing. I have the choice. Now, here's where buying a call and buying a put are different. They're literally identical in every other thing. The choice to do something with the stock for the strike price at expiration. What's the only difference? One little word. When you buy a call, you have the choice to be able to buy the stock if you so choose. When you buy a put, you have the choice to be able to sell the stock for the strike price amount if you so choose. A put option does not give you the choice to buy. It gives you the choice to sell if you want to. So whatever the price of the strike price is, no matter how low the stock goes, you would still have the ability to sell at the higher strike price. Imagine the strike price was 80 and the stock tanked and it went down, and it was trading at $60 per share. Well, it would come in handy if you had bought a put. Why? Because you have the choice to sell that asset for 80, even though it's only worth 60. You see that? That's why puts go up in value when stocks go down, because you have the ability to sell high even as the stock has gone low. With calls, it's the opposite. I can buy the stock for the strike price. So stock price going up creates value. If the stock goes up to 100 per share and I own the 90 strike calls, well, I've got an option that's valuable. Why? Because I have the choice to be able to buy the stock for 90, even though it's worth 100. I have intrinsic value there. I've got the ability to do something. So again, don't get overwhelmed if all of this doesn't make perfect sense at first. We're just kind of doing an intro so that you understand a little bit more about a couple of strategies here. Selling a call and selling a put. Again, it's only one word difference, but notice they're only different by that word, but that changes everything, doesn't it? Now notice that selling options is different than buying. With buying, we have the choice to do something. When we sell an option, we make a promise. We have an obligation. We are required. We are committed, right? We have The option buyer has the choice. He has the option. We get an assignment if they so choose. So when you sell a call, you're making a promise to sell the stock for the strike price if the call buyer so chooses to exercise their option. If you sell a put, you're making a promise to buy the stock for the strike price amount if the put buyer, if the person on the other side decides that they want to make you do that. And they will make you do that if the stock is gone past the strike and that option is in the money. So when you sell an option, you are making promises. Now, what's the benefit to selling? Why would I want to make a promise? Well, insurance companies make promises, don't they? But they get something for making that promise. They get premiums paid to them. So when you sell an option, you collect a credit. You get paid a premium. That's money coming in. It's a beautiful thing. When you buy an option, you're actually doing a debit trade is what it's called. Money is going out. So I love how Andy teaches this. We use the stick figures. Okay? In any option transaction, money is going from one person to the other. And if it's going that way, this is the option seller, right? Because he's collecting the premium. This is the option buyer. He's paying the premium. He has to pay to have the choice, the option. We collect because we're willing to make a promise. And so we get to collect that premium. We get to generate income. So coming back to Oxy, we said, well, we could buy and hold it, make 1-ish% per year. But what if we not only made the dividend, but what if we tried to sell some calls against it? You know, what if we tried to dangle a carrot a little bit? What if we said the stock's down here at, 60-ish, and what if we tried to bring in some additional income? The way that you do that, it's called a covered call. The name comes from the call option being covered by the stock. So I own hypothetically 100 shares of Oxy stock. I can sell a call against it, make a promise to sell, and I have the asset to deliver. So I'm not making a promise naked where I don't have it covered and protected. I'm making a covered promise. I actually have the shares. If you want to buy them from me, you got to pay me the strike price, but I can deliver the shares. So we can make this call sell naked, or we can make it covered. If I own 100 shares of the stock, then when I sell a call, it is now a covered call. So if we just came over and looked at an example here, and we said Oxy's trading at 61.55 or so, we could pull up some options, and depending on how short term or whatever, we usually sell a covered call quite a ways out there, meaning in strike price. We're kind of dangling the carrot. It's not just about the income. Sure, we want to collect some income, but we probably want to participate in the upside and keep owning the stock, hopefully. We're not really interested in losing our stock position. We're more interested in just owning it, generating premiums over time. So something like this could make sense. The stock is trading at 61.55. I could sell a 70 strike covered call for about 75 cents. So now we have a couple of examples so far that we can plug in and compare and contrast, okay? So we say first trade was going to, let's just drop the details like this. Buy 100 shares of Oxy at 61.55 and generate, what was it, 52 cents per year in dividends. Okay, that's the income coming in.
I love to watch you work. And this is really, what I talked about, in that, a person might say, well, gee, for every $61 I got, I'm only getting 52 cents. That's rough in terms of my goals, right?
Absolutely. And you're basically creating with this covered call. The benefit is you're creating an additional stream of income, but more on a monthly basis. So check this out. We already have two comparisons here. That was bringing in about 75 cents for about a month. Now, it's a little over a month. Can we call it a month? It's 39 days. You okay with that? We'll kind of call it a month, but this is not something that we can count on. It won't always be 75 cents per month, but we're kind of giving a comparison here,
Let me
right?
interject here is that, another way to increase your rate of return is by the use of leverage in terms of margin, right? And if you try to factor in a bank, this for Mayor, if you try to factor in bank interest, like an example of 6%, if you're going to use leverage to buy or sell options, calculating that net profit is pretty simple. If I get 10% of my option, annualized, or 20% of my option annualized, but I used borrowed money to do that, well, I got to subtract 6%. And using borrowed money to play with the options market is really playing with fire, in my opinion. I would be very cautious with using any type of leverage and margin rate in doing it. So while the math would be
Agreed.
calculate, I can't tell people what and what not to do, but I would say that with my own sons, I would use my leverage more in the real estate market or in the business arena, and I do use margin at some times, and the rates have been a lot higher than 6%, depending on where you go. Interactive Brokers is the best I've found. But I just want to interject that because there's a question on it, and I'd like to hit that. So there you go,
Yeah,
Corey.
and margin can really just create some problems because now you're using someone else's money, right? And when you get into someone else's money, now they could liquidate your position. Now they have some control, and I just don't like giving up that control. So if I ever use margin, it would be a very small amount, but I pretty much, if I've got, $1 million in the account, I trade $1 million worth of stuff, but not 1,000,001, or whatever. You just trade what you have, kind of. That's my philosophy as well, for the most part. So that creates a lot less risk there. Now, you'll notice here, if we look at these rates of return on this example, both positions bought the stock around current prices and collect the dividends. But here we're creating another income stream. Now, this will not, that 75 cents per month would be $9 per year. I can't say that you're not going to have to buy back the covered calls from time to time at a loss and so on. So let's be conservative. Let's cut that at least in half or so and say, maybe after adjustments, and sometimes you have to buy it back at a loss or something, let's conservatively just call it about 450 per year, something like that. Now, the reason I want to show it that way is because my experience is that's a more accurate depiction of how the markets work. I'd love to tell you that you're going to go out and sell calls and they're always going to expire and you're always going to make that money, but that's not reality. So reality is sometimes we have to buy back the call we sold and roll it out, and sometimes we have to buy it back and take a loss and so on. And you'll experience that as you start to demo trade these. But you can already start to see the difference is how much income is this guy generating? Well, it's less than 1%. We already looked at it. It was like 0.8% per year, right? That's the dividend yield. So this guy, at that, just at the dividend level, is making little less than, but we'll call it 1-ish%. Just by adding covered calls. and being, I think, a lot more conservative by cutting the annual number in half. Now we're bringing in the 52 cents in dividend still, but maybe we can squeeze out an extra 450 per year in income from the covered calls. We'll look at the $9 number in a second, but if we could just bring that in, that's bringing in 502 per year just in income off of that position. The stock costs 61.55. That's 8% per year. That's not including any appreciation in the stock price, right? If the stock price goes up or goes down, it's going to increase or decrease that rate of return. This is just purely the income side. Now, if you could have collected the full $9, if everything worked perfect and you were able to collect about 75 cents per month or whatever, well, now, of course, it'd be almost double. It'd be 15% per year just in income. But I think taking the conservative route and saying, okay, on the income side, maybe we could collect 8% or so return on investment just on the income side. So 1% in the buy and hold, 8% in the covered call. Now here's why some other strategies can make sense. First of all, we could say, I might want to own this stock, but before I buy it, I might want to make a promise to buy it cheaper than where it is today and get paid some money to do it. So instead of buying today at 61.55, we could make a promise to buy the stock. And then if we wanted to, we could buy some protection just in case things went really crazy. So you could do this
Now that's
naked.
key, Corey. Let me interrupt there because that's a key. The fourth pillar, risk management, becomes so vital as you start to consider multi-leg trades, trades where you're making promises, where you're getting paid to bind yourself to obligations. I shouldn't say bind because they are liquid, but I still think that's a good word. So that's a big deal. So just really, we can't scream about risk louder than that.
Yeah, absolutely. And all of these positions have risk, right? There's no guarantee that this stock price isn't going to go down for the buy and holder. If it's going down for the buy and holder, it's going down for the covered call trader as well. And this trade could get into trouble. But we'll just look at some different variables here. So this is something where we're basically creating what they call a spread. We're going to sell a put, which is a promise to buy, but then we're going to ensure that by buying a lower strike put. And this is called a bull put credit spread. We're going to get paid money, income for this. And we don't own the stock in the third scenario. Both of these own the stock right out of the gate, which means you're locking up $6,155 right out of the gate. We're going to make a promise to buy it cheaper and then buy some reinsurance in case. And then, maybe it is our goal, maybe it's not our goal to own the stock. You'd have to decide for yourself. If it's not your goal to own the stock, then this would be more of just a speculative trade that you would need to hedge and protect and be prepared with some risk management aspects to it. If this trade goes against us, we'll probably show you some of those. We'll demonstrate. This is meant for educational purposes, right? So the third strategy is just going to start with options at least. And we're going to do a third strategy. It's called a bull put credit spread. And I'm going to look for something that's similar in income to that covered call example. Remember the covered call was paying us about 75 cents?
And if I could interject here,
yes,
Corey,
please.
if you go back to that word, bull put credit spread, that's a mouthful. So one of the things we do, and we do this, by the way, in the Ultimate Options class with probably 20 different trades like this, is you break it down word for word. Bull, Well, that means, our sediment is going to be slightly to the upside. So it's that neutral to moderately bullish that Corey and I were speaking of.
Yeah, where do you get hurt? A bearish move, the
Yeah,
stock going down a lot.
and it's going to be a significant bearish move, by the way.
Yeah,
It'll be
yep,
significant. So bull means sediment is mildly to strongly bullish. Put, that's the instrument. Credit means we get paid to make the trade, like a covered call. So we're making more promise than we're buying. In other words, the promises we make will be more valuable than the promises we buy at the beginning at face value. And the spread means we're going to take the money, the distance or the difference between those two premiums. And there was a great question by Cleve Burbage, who said, well, I really can, what about selling the puts if I have the cash as a cash secured put? Love it, want more of it. But it is going to be towards more of a covered call type premium there. We're going for more. We're definitely going to, hopefully, when this is done, show, the dividend one, the call one, which would be very close to a cash secured put one, and then show a markedly better, more rewarding rate of return, possibly.
yep. And here we can kind of show, like, with this bull put credit spread, if I come over, so I'm going to kill some of that, but we can come back to that. I've got it mostly written out on the screen there. If we came to March, now instead of dealing with the calls, we're coming over here to look at the put options. And what we're building is basically a trade that says, okay, what if it does go down? We could own it at a better price. So watch this little alternative. What if we sold a vertical? So all I did was right click, sell a vertical spread, and I'm going to flip these a little bit here and bring it down to just one simple contract. And what if we sold the 55 put and bought the 50? That brings us right around that 70 cents. It's 69 at the midpoint. I bumped it up 1 penny to be close to the same amount of income as the covered call side. To be close, not the same, but in that same ballpark. So now we have another way to present a strategy here, another approach that basically changes some of the elements, but could improve some things, because what we did here was we were looking to sell, and I'll come back to the details in a minute, but we're going to sell the March 15th 55 strike put, and simultaneously buy, this is all done as one order, the March 17th 50 strike put. Now we get paid about a 70-cent credit. If you look at this trade is really quite interesting, because we know that this one was around 1% annually, and this one was about 8% annually just off of the income. This trade does not tie up a lot of capital. This trade only has a max of $500 spread at risk, because in the options market, you're controlling 100 shares of stock per contract traded, right? One contract controls 100 shares of stock. So one contract is equal to that control. So we're making a promise to buy 100 shares at 55, but we bought our way out, if we want to, at 50. So we really only have $500 at risk in this trade. And then it's even better than that, because we got paid $70 for the trade. So we really only have $430 at risk, which also just so happens to be the amount of capital required for this strategy. So we could make, if this trade works as expected, let's pull up the calculator, we could make $70 of profit on $430 of risk. But that's 16% for a month. That gets ridiculous when you start annualizing that, right? You start saying 16 times 12, and all of a sudden you've got some huge numbers. But remember that this position had very, very little chance of going to zero, of realizing a max loss, of the company going bankrupt. This trade has a very real chance of maximizing its loss, of losing all 430. So yeah, you're making 16% return on invested capital for this month, but you also have the potential to lose 430 bucks or 100% of the risk that you put in there. It's a higher risk, higher reward situation. What it really does is gives you some opportunities, gives you some flexibility. And if, as was it Cleve that asked about buying the stock? If your goal was to buy the stock, this would be one way to potentially do it, where you have less, you're not naked, so you can decide at March expiration. If you decide you don't want to buy the stock, you could let this one exercise. If you decide you do, you could sell this one back for some profit and have them deliver the stock. There's flexibility with it, and there's less overall risk. So that's kind of the breakdown in terms of the percentages. We're talking about 1% annually, 8% annually, or 16% return on invested capital for 1 month. Here's what could end up happening. If the stock goes to the downside, this position would have been down a lot, right? Let's say the stock fell to, let's pick a bad number, $50 per share. I don't think there's any chance that's going to happen by May 17th, but who knows? Maybe it will. So we go to 50. This stock would have gone from 61.55 to 50. You'd be down 1,550 bucks, right? This one, same thing. You'd be down 1,550 minus the covered call income of 75 cents. You'd be down, 1,500-ish. This one here, we'd only be down 430, and we could decide to go ahead and buy the stock down there at 50. We could pick up the stock if that was our original goal. Notice we're in a much better situation on this third one rather than buying the stock outright if it does in fact go down. As long as we haven't over leveraged, as long as we haven't done something not very smart, we're in a much better situation in many of the possible outcomes that occur here. So we've got a few questions that came in. I like the idea of doing spreads, but limiting risk. So yeah, if you're doing these, first of all, it's a paper trade example to start, no question. Like, we're going to put this in a paper trading account and we're going to track it.
Let me talk about this, Tanya. When people aren't allowed to do spreads, generally it's an experience issue. For example, I don't do much personal mentoring. Well, I really don't do it hardly at all. I have one person who's a friend who has asked me to mentor him, and he and I meet at 10 o'clock every Thursday. But he had never traded before in his life. So when we started, there was some issue where he says, well, I want to do all the stuff you do, but he was limited to covered calls and cash secured puts. It's okay. As soon as you grow a little time in that account and you show some proficiency with, buying some stocks and writing a covered call or two, you can approach them and say, hey, I'd like to talk to you about my net worth. I'd like to talk to you about my trading experience, my education, and they'll give you that access. That's not permanent. And so it's just be patient with that, I guess. Any comments on that, Corey?
Yeah, that's a great point. And if you think about the options market and them giving you access to different trades, nobody has experience at first, right? They have to allow you to trade, because somebody that's brand new, and everyone starts at some point in time as a brand new trader. So of course, they'll allow you to trade with no prior experience. Like Andy said, they might just make you, you know, kind of gain more experience, have a little bit bigger account size, whatever their concern is. And usually, generally speaking, you can just get on a call with them and say, hey, I'm, taking these courses, I'm educated, I'm ready for it. And they can kind of increase your trading levels. It's really them trying to protect themselves. They don't want to give you approval and then have you come back on them and say, why did you let me do this? This is all your fault. I wasn't ready. They just want to protect their backside. That's what it's all about in essence. So very good points there. We will paper trade this. If you look at a couple of things, I won't emphasize all of it. We'll go through this over and over again, but here's a little interesting side note. The delta, the probability of success. If we bought the stock, we're just kind of 50-50 on whether it'll go up or down, right? Here, this says there's only a 20% chance that we'll be below that strike price that we're selling, which means if there's a 20% chance it will, there's an 80% chance it won't. So in essence, we're starting with an 80% probability of success, a probability that this trade will expire worthless. Now, picking the stock direction is kind of a 50-50 game. Here, we're starting the trade from day one with about an 80% success rate. That can get people in trouble because they fall back on that and they say, well, I had an 80% success. It can never go wrong. No, it literally means that 2 out of 10 will go wrong, right? You're going to have some trades you're going to have to adjust, and we're going to talk more about that, no doubt, in coming sessions as well. The 80% is using the delta. The delta, we call that the poor man's probability. So since we're selling the 55 strike put, that's where we're saying we don't think it's going to be below that. We want to collect that income. There's a 20 delta. That means there's a 20% chance it'll be below 55, or AKA the 80% chance it won't be, right? We have an 80% chance that this will just expire worthless for a full profit. Good stuff.
Muted there.
Oh, you're good.
So I say we make this. So what we'll do is we'll make this trade and we'll set it up. Just by percent return, what's the percent of that again? I mean, the probability is 80%, but what's the ROI extrapolated over the year on something like this? A year, annualized.
16.2 for the month, annualized. It's 200% almost annualized, So
on the one end, you've got a 5% dividend. On the other end, you've got a 200% work on your cash. Now, before we start smoking Colorado grade marijuana.
Right.
Actually, I shouldn't pick on Colorado because most people legalize it now. They were just pioneers in that. I've never indulged, but hey, there's always tomorrow, I guess. But 195%, the worst thing you can do to react to this is say, oh, great, I've got a way to, now, oh, great, I can pound my way to heaven. Well, there's going to be some of these that go wrong. In our Ultimate Options class, we have time to delve into that, greater detail than we can in a quick start lab, because it's not a quick way to start a conversation. But there'll be months where we don't make this and we'll have a losing trade, just as there is with a covered call or cash secured put. You can go in the money, you can go outside the range. 20% of the time, you got to remember, with an 80% probability of success, there's 10% probably it goes outside of this, right? It either side, or 20% probably it doesn't happen. And so risk management will be the key. And so as we watch over this over the next, 4 weeks, when's this over with? 27th.
This one will be 17th of March.
We'll have a pretty clear picture where this is by the end of the quick start lab.
For sure.
Corey will try to enter this trade, see if he can get filled somewhere in this neighborhood. Might be better, might be worse, but give or take, 195% annualized. That's pretty good. That's the first quick start lab. Did you guys enjoy this? Was this good? Andrew Lim has a question. Can you build this in a risk graph and show that 80% probability? He says, how do I see 80%? Can we actually build this trade, Corey, in a analyze tab?
Yeah, absolutely. And I was just doing a quick delta. So delta is just kind of a quick, what's the
70,
probability?
90, yeah.
It'll differ a little bit when we get to, that's why we said it's the poor man. It's kind of a quick, hey, what's the probability? Like this implies that there's a 6% chance we can be below 4750.
Let's click on the analyze tab.
Yeah, I'll do that. I was just pointing out that it will differ a little bit. So watch this though.
It's a short way. It's up there. You don't usually.
Where did my trade go?
You usually use Interactive Brokers.
Yeah, it's right here.
Right click on that and hit analyze.
I already clicked the send. That's why it was over here. And then I got to uncheck these things because we already have some stuff we've been screwing around with. Okay, let's get those off. So here we just have this bull put spread, and we need to.
Is that trade working? Did you set it working?
I put it working, so I'm going to do this.
Page. Yeah, go to your monitor page.
I'm going to kill it.
Click on that. No. Analyze trade all the way down.
Well, I did that, but I've got 5 contracts. I just didn't know if that was going to confuse.
Try it.
I don't know if it matters. But
analyze that trade.
Yeah.
There you go.
I was just trying to avoid the number multiplication, but it's fine.
You can change it down there if you scoot that up. You can actually change it to 1.
That's true.
If you want to
do that.
There you go.
Yeah, and here's what we were going to look at in terms of the risk and reward. So the probability of us getting to 50, if we just look at the probability of us getting, to 55, see it says right here.
Go break even. 21%.
Even go break even.
Right there. Go break even.
19%.
Probability of screwing it up if you get right on it.
And so see how it's close to that 20% that the delta showed. Yeah. And if you go to that strike price, it's 21. A little bit different. It's 21%, right? But it's in that same ballpark.
The shaded area in J, Andrew, the shaded area in J, Andrew, in gray, that's a standard deviation. So that's usually where this stock wiggles around. So we've got a little bit of chance within its standard deviation to have some problems, but not anything that would scare me away. Some guys are like, this was confusing. It's quick and start. Stick with this. It'll keep getting easier. It's like moving to Japan, a little bit of immersion. But by and large, we got some fans. So this is.
And we'll go through it thoroughly over and over again with talking about probabilities and talking about risk and reward
So let me just summarize. Even if you don't understand how we get to the trade, I'm just going to summarize what we've done. We've made 2 trades. The first trade, if you can take your cursor down to the red, Corey, we have a -1 here. It says, look, we're going to sell a 55 strike put that expires in March. And that basically means on one trade, we're promising to buy this stock if it gets to 55 or below. Right now it's at 62. So it's not likely to get down, but if it does, we're promising to buy that. Now, we're also buying some insurance that says, and we want to be able to sell that stock at 50 if it goes too far, which gives us $5 of risk. $5 of risk. Now, since we received 70 cents, that $5 of risk is reduced to $4.30 times 100 shares means $4.30 of risk, and our reward is 70 cents or $70. Now,
and you can see those lines right here. See, as there's a kink and there's a kink, right? There's a corner and there's a corner. That's at 55. And so if the stock finishes at 55 or higher, See how the number down here is plus 70? We made 70 bucks, 70 bucks, 70 bucks. No matter how high it is, as long as it finishes above 55, we're plus 70. We get to break even right in here. We start to lose right in here if it's landing in here, and our max loss would be this corner if it's at 50 or lower. If it's at 50 or lower, we stop our loss. That's what that reinsurance buying of the put did, but it caps our loss at the 430, which we said was our maximum risk, the worst case scenario.
Fantastic stuff. So that should do it. We'll put that trade on and see what we can do. And it's exciting to explore the range of return that we can go for. And I really like it because I usually don't, have to do this that often. This is for me more opportunistic. This would be something I would do if it's not a mainstay because I don't need that. I'm, started pretty young, but they're really fun to do when the setup's there. They're really fun to do, and if you know how to manage the risk. So hopefully this thing might go down into this, scary area where we might have to make some adjustments here. Hopefully it goes down and that we're wrong in our moderately bullish. I would love one to be wrong because it's fun to advertise, say, yeah, we batted 1,000 in COVID and last year we batted 1,000. But it'd be nice to have one where we went wrong because that'd be equally powerful to advertise the program.
Yeah, it would be better. It'd be better for the educational side. Absolutely.
Last thing before everyone goes, I'm going to make a special announcement, and it's pretty cool. I'm curious, how many of you guys know who Than Merrill is? Like, who names his kids Than? Well, my brother's name is Nathan, and it's a form of Nathan. Like Andrew is my name. I have friends call me Drew. Nathan is my friend. They call him Than. Who knows who Than Merrill is? Say I do or I don't. Some yes, some no. Okay. Those of you that know him, most don't. Okay, most of you don't. Than Merrill was a Yale graduate, played football at Yale, got drafted by the Tampa Bay Buccaneers, played 3 years, got traded to Chicago, blew out his knee. And he started buying real estate. And he now has about $1 billion of real estate under management. So it's pretty cool. And he has a company called Fortune Builders, which is exactly like the Cashflow Academy with stock, but it's with real estate. And one of the things he did about 10 years ago is he reached out to me and he said, Andy, the strength of your company is its simplicity in communication. Come train our guys. And I also, before you guys know my story, that I used to sell software. That's how I got into trading, selling software. And I became very, very good at sales. I don't have a lot of talents to brag about, but I really know how to sell. I'm very good at that. And ironically, Corey, that I wind up trading stock where you sell by clicking a button instead of. So I trained. He hired me years ago. He said, I'll pay you a massive consulting fee. And I said, well, mostly I think it'd just be fun because what I really want, Than, is your knowledge about your company because it's fantastic. And he and I became friends, and we would often do a 1-2 punch and be asked to speak on real estate and stocks as a 1-2 punch. But he really got interested in communication, and he's a very good negotiator. I was a good salesman, and both of those are important in real estate. And he said, Andy, would you come in and let's open that up to my students at my Fortune Builders company? I said, sure, because it made sense to me that real estate investors would want, you're going to be working with realtors and hard money lenders and private equity and, all kinds of persuasion, buyers, sellers of homes, contractors. And so we developed a 2-day program called Sales Negotiation. I've done it with him once a year for 5 years. And I've just done it for his students and Fortune Builders. I've never, thought to really offer it to the Cashflow Academy students. So I'm curious, how many of you guys would be interested in having a real estate portfolio? Mine's not as big as some people's. He has $1 billion in his, but I have a lot in mine, enough to make myself happy. Who would like to learn a little bit about that? Just say aye. Okay. So here's, Jennifer oh, Jennifer did the class. So I have a testimonial from Jennifer. It was amazing. So look, I'll highlight. We have one person that has done the class. Oh, everyone says I was introduced to the Cashflow Academy through Fortune Builders. Absolutely. So let's highlight some of the things people are saying here about my buddy Than. So anyway, for 5 years, we did this class once a year, and he's growing his business now to he's in the looking to expand in the $1 billion of levels rather than the small stuff. And his family's growing. I'm very close friends with Tice and all those guys. Am I showing my screen? Should I show it? I guess I should if I'm going to take a screen capture stuff. Thanks, Corey. And so anyway, he said, I'm not going to do the sales negotiation anymore. I'm going to move and have less time in the education arm of what I do and more in what I do. You've heard me talk about him. Let's see. I was introduced for the Cashflow Academy Fortune Builders. Lynette, hello. And Jennifer actually did the class. So it's a 2-day class. And Than says, I want to do a grand finale. I want to do one more with you, Andy. Will you do one more? And then I'm going to retire the class at Fortune Builders. And he's retiring several classes because his ability to teach is being hampered by the sheer volume and vastness of having to manage an equity fund now that is just beyond belief. And he really has a somewhat of a fiduciary responsibility to tend to those monies. So I said, all right, we'll do one more, and we're going to do it in March. And he said, you've never offered this to the Cashflow Academy students. And he said, Andy, they would love this. They would freaking love this. I go, they're all stock traders. We sell stuff by clicking buttons. He goes, don't be so sure. He says, based on what my students have said about it, you should open up to them. So I'm not going to put this on Twitter yet. And Than has just started to open it to his students' registration. The good news is we got about 300 seats in the room we're going to get. Bad news is we only got 300 seats in the room we're going to get, and then we'll have to cut it off just simply by the size of the room. So question, would you guys like a sneak preview of that? I'm going to let some of the students in the Cashflow Academy know, and you guys will be in that group. Anyone who has been like in a mentor club for a lot of years or attended a quick start lab, you're far enough along as a student that you make that first come, first serve status. It's travel, it's live. I've never done a live class, ever. I've never done a live class in my life. So I built, and this is probably bad because I don't even know if this is the right presentation. I haven't even named it right. It's still, I used the Cashflow Investing Secrets template, so it's not even the right one. But I've got 2 opportunities I'm going to give you guys for stab at because you showed up. So there's a reward for coming on the live one. The challenge is I don't know, if people like to travel to these things, and it's not going to be an expensive workshop by any stretch of the imagination. But we're going to do this thing called sales and negotiation, and we're going to teach you how to work with lenders. And I'm going to, like, my talent, my part of this really, when I went in and consulted with Than had a list of all the objections. Literally, I had him prepare by writing down every objection he gets. So when he goes to a lender, and the student has never done it before, and the lender says, look, I'm not going to invest with someone new to this business. Okay, how do you handle that, Andy? Use your magic. And I show them what I do. Contractor, well, I need to use my paperwork, not yours. How do you deal with that? Well, I'll show you what I do. This is common. When you go to buy a house, you usually put in a pretty low bid, and they say, well, or excuse me, your offer is too low, right? Or what have you, right? Or your price is too high when you're selling it. And the skills are worth a lot because you can have a $20,000 to $60,000 swing either way. So we built this playbook that shows you how to approach, and we practice. We practice live. Than and I become insane friends. Our families are close. We go to Vegas for our birthdays. We meet with our wives and go to shows. He'll come up and catch a Jazz game. I'll go down and catch a football game in California. I mean, we're tight. And so that's kind of our background, and it's been an incredible 1-2 punch. So we're going to go to Houston, Texas on March 20th and 21st. And Dan convinced me, says, you are doing your students a disservice if you don't let them have at least one crack at this. So this will be the 6th one we've done. We've done it for 5 years. This will be the last one. He's going to retire the class and not do it anymore. And so if he's not going to do it, I probably won't do it anymore. But he said, your students would really love it, even the stock people. So I guess the thing we're going to find out is if he's right and if he'd like to do that. And I'm going to let certain people should get an invitation for a Wednesday night meeting. If you got one, that means we think you're special. Not everyone got one. Some of you are going to say, I didn't get one. Some of you say, I got one maybe. But if you want to get dibs on this early, I don't even have a registration page ready yet. It'll probably go live tomorrow. You can send me an email if you want to come and say, I'm in. You get a +1 guest. And it'll be a 2-day training event. Now, so that's the first part. So first of all, who would have an interest in, hanging out with Than and I for 2 days and learning a little bit about real estate investing from the two of us? Just say I if you have an interest, because I want to get a feel of, would people really get on a plane? I know the fortune builder people do, because real estate is always taught, in live stuff. You can't really do it online very well. But cash flow, that's stocks. We did it very sufficiently here, over the internet. So there you go. So send an email to support and say, it's a couple $1,000 to go, but send an email to support and say, I'd really be interested in being with Andy and Than on Houston. Last one they're going to do. And I've got a reel. Corey, have I shown you the reel?
No.
I've got a 1-minute reel. Can you guys survive a 1-minute reel? I've got a one. I didn't put this together. His people put this together. So we've got a 1-minute reel. God, I'm not even ready. I did this in Mentor Club. We're only letting people know about it today. So let me go to Google. And it's in a Google document here. Hang on, Google Drive. I'll find it, and sales and negotiation. And I don't know if you can hear this, Corey, so this might be way anticlimactic. So you tell me if you can hear it. Ready and go.
I had so many aha.
Can you hear that?
Yep, good.
Okay, here we go. I love the finale of this. Okay, here we go. 1 minute, 18 seconds. Survive this with me and Than. Here we go.
I had so many aha moments this past 2 days that I couldn't even count.
The cool thing is Andy and Than really work well together. Not only how they present, but what they present.
I had a lot of fear about talking to realtors, contractors, and sellers. I definitely have the confidence that fear will be a lot more minimalized.
It's 2 days that will change your life.
You can apply to every aspect of your business, whether it's wholesaling, rehabbing, rental properties. It's an amazing thing to add to your arsenal.
Being able to communicate better is definitely going to help in my business, and not only really my business, but my teams, and being able to talk to them a little bit better.
Whether it's private money lending, contracting, whatever the business is, just know how to come into a discussion and know how to sell.
The tools that they provide, the steps you can practice. That way, when you go into it, when you're doing business, it makes it easy.
It's nice because they're always there to give advice.
If you have not been to sales negotiation, you need to come.
Absolutely. Your personal relationships, you can take this information anywhere. It will change your life.
I recommend you do it as soon as possible. It's a must do for everybody.
This is one of the best seminars that you could ever go to.
You actually have to be here to experience it.
If you haven't been to the sales and negotiation event, you're missing out big time.
It's been a tremendous 2 days and a great value.
On a scale of 1 to 10, recommendation, it is a 15.
Okay, so 15, there you go. It's one of my favorite events that I've ever done. So what happens is we give you an 8-week online training course. So you'd have to cram because you only got 6 weeks, but you can get it done. And then we do the 2 days live in Texas. And that's cool. So that's the first thing. And I'll tell you why I would go, even if I was just a stock investor. Than Merrill's a Yale graduate. He's a professional football player, and he's bought $1 billion of real estate. I'm just going to tell you this. If you can spend 2 days in a room with someone who has gone from nothing to $1 billion in assets, I would want to hear whatever he had to say and do whatever exercises he told me to do and have whatever fun we're going to have in there. Very few people get the chance to hang out with someone who has conducted $1 billion in real estate transactions and bought, shopping malls and, multi hundreds of millions of dollar, projects. So I don't have a registration form, nothing. I'll probably have that ready Wednesday. But if you want to get dibs on your spot, because he let it out to his guys, and it's gonna fill like way fast. And so we're kind of timing this where both the Fortune Builder students and the Cashflow Academy students, his are going to beat us by a little bit. We're going to get the word out on Wednesday, and then we're going to fill it. So that's the first opportunity I had. So I don't know how to, you go to your support ticket or support tab, or send us some kind of an email and say, hey, I heard about the sales and negotiation. I know it's 2,000. I know I get to bring a guest. Send me the hotel information. Here, they'll direct me to the site to buy it. I don't have it ready right now, but if you want dibs on that baby, it is phenomenal. Scale of 1 to 10, recommendation 15. Me too, because I learn a lot too. I've got people saying dibs right now. People are asking for dibs, so that's pretty cool to have in there. Okay, now, so then Than is one of my mentors, and Than says, Andy, you're going to be down there. Have you ever taught your students live on stocks and done like an intensive, 8-hour a day, like, bring your questions, bring your stuff, look in our eyes, Q&A. Have you ever done a stock class? I says, nope, never one time. I've been asked to speak thousands of times all around the world by other people, but I've never done a live event for the Cashflow Academy. He said, you need to take this opportunity to do one. So event number 2, if you want to hang out with Than and I for the 20th and 21st, we'll be there live. Noah and Corey are going to fly down for the 22nd, 33rd, and all 3 of us are going to be there for the first time. We have never done a live event, 3 of us. We've never done a live event for the Cashflow Academy, and we may never do one, this total experiment. But what we're going to do is we said, all right, if we were going to do a live event, what would we teach? And the first thing I would do is say, I can't guarantee to double anyone's cash flow. I can't make that promise. But I will tell you, often when people bring, what they're doing, and we can say, all right, let's use you for an example, what would it look like to get more income in what you're doing? So that would be one of the objectives. Number 2, I talked earlier today about some of those numbers and getting clear on, the time, the percentage, the beginning amount, the thing. And so we have this exercise I'm going to do called Building the Dream Retirement, where we don't compromise. We say, okay, no stops. We're going to pull out all the stops. We're going to build a dream retirement and a date to get there. And then we're going to see if it's possible. Once you put a price tag on it, and once we figure out what we need to do, then you might be surprised at what you can achieve in this world. So we're going to do that. We're going to do Warren Buffett stuff. We're going to do Q&A. Corey is going to do some advanced technical analysis, some Bollinger Band stuff we've never done before. So we're going to take kind of a wonky deep dive into, what a Series 4 option principle does at a high level. And we're going to do this. So we're going to do a 1-2 punch here. So that's the most I've worked in probably 5 years.
Yeah. You're going to be worn out by the end of that.
I got to get my cough under control if I'm going to do this.
Well, I just have to say, from my own personal, kind of selfishly, I hope as many cash flow students can be there as can possibly make it, because just the interaction with all of you, I thoroughly enjoy it. We love teaching. We love working with you. So if you can make it, it's just so much fun to meet you in person.
I want to take selfies with people, so I have pictures of people just to show my kids that, what I do. I want to shake your hands. I want to hear your stories. I want to hear your struggles. Our Q&A sessions, I think we're going to do 2 of them. So we get lots of individual attention. And so those are kind of, this is the thing I'm going to talk about on Wednesday. I'm not done building it yet, so I really don't know what I'm doing yet. I'm still building this explanation for Wednesday, but I thought I'd give you guys the sneak peek. So it's going to be March 20th and 21st, and with Than and I, and 22nd, 23rd. The ballroom holds about 200 to 300 people. I think we can get 300 in there. That means 150 registrants plus a spouse, which means 75 seats for the Fortune Builder, or 75 registrations for the Fortune Builder side, and we're going to put 75 people in us. So this will fill, in my opinion. And before I put this on Twitter or Facebook, or my team advertises it, you guys get first dibs. Why? Because we love you. There we go. It's going to be special. And oh, here's the thing. I'll do, you can do, they're 2,000 a piece, but if you want to do both, you can do either for 2,000, or you can do both for 3,000. And that's going to be the offer I'm going to give. So pretty good, pretty good value. So if you do both, you know, it's pretty good to hang out with guys that have been pretty knowledgeable. So there you go. Great quick start lab, right? Great quick start lab.
So much fun.
It's going to be a ton of fun, and get your tickets while you can. I bought my plane ticket, so I have a ticket to go.
Oh yeah. I still need to get mine, so
I got to get you guys
I'll
one.
get there. If I have to take Greyhound, I'm gonna be there. I'm so excited.
We'll jog. It's going to be special because, you know, I'm dear friends with Than. I'm equally close with Corey and Noah and our wives and our families. We have great parties, and this will be, I don't know. I've never done this one. I've done this one a bunch of times, so I know it's special. Never done this one, but my feeling is lives will be changed, and that's the whole purpose of the whole deal. So there you go. Had fun in the quick start lab, man. That was a ball.
That was a blast.
So there you go. Look how many people don't know Than yet. Some people do. Some people don't. Well, you ought to get to know a guy that has done what he's done. I'll tell you that. Okay, we'll see you guys. When's our next one?
So
Corey?
we have Thursday, another evening. So we've got some during the day as well. We kind of mix up the times, but Thursday, a little bit later start time. I think it's 8 p.m. Eastern time, 6 p.m. Mountain on Thursday. So we'll see everyone then. So excited.
I can't type fast, so I just answer this. Lynette says, hey, is there 300 person cap for the summit? I think that's about all we can squeeze in, because we're going to use the same room, same hotel, same room. And that's what the person that's doing the hotel contract with us said. Yeah, that room will hold about 300 people. So that's what we're working with. So hope you get there. All right, guys. Awesome. We'll see you next time.
Good night, everyone.